Hi, my name is John Light, and I've spent over 20 years working throughout all corners of the recruiting world. Our podcast, Drowning in the Tech Talent Pool, is a resource to help you stay afloat and get ahead of your competition. Hi, and welcome to another episode of Drowning in the Tech Talent Pool. I'm your host, John Light, President, CEO of Sabretooth Recruiting, where we focus on tech talent, among other things. And with me today, I have Gus Bessalel. Gus, I hope I said it correctly.
You're perfect.
I'm from Texas, and sometimes the drawl messes things up.
Perfect.
You never know.
But John, I answer to anything, so it's all good.
Well, one thing I do know you answer to for sure is you are the writer, the author of a book called The Startup Lottery. And it's actually one of the things that intrigued me about our conversation today is knowing that you have a background in the startup world, a serial entrepreneur, someone who's risen through executive ranks as well, and had a lot of interesting projects in your background. But to write a book with what I think is something of a provocative but accurate title about the startup lottery, I'm wondering if you can kind of lay the foundation career-wise, pathway-wise, that got you to the point where you produced the book and what it's about.
Sort of starting at the beginning, when I came out of college, I worked for a management consulting firm. And then after business school, I went back into the consulting business for a few years. And part of the frustration I had with consulting was I was a little bit too far away from the action. So when I was 29, I decided to start my first company. And so I've been in and around startups for more than 30 years. And the last one I was in, we sold 2 years ago. And I was kind of reflecting on the journey and thinking about, the dynamics of startups, the fact that a lot of startup employees don't really understand a lot of what goes on behind the scenes, particularly when it comes to how equity works. They spend a lot of time working in these companies. They have ostensibly ownership percentages in these companies, right, when they get option grants and RSUs. But there is a lot of confusion about what that equity means, what to do with it, whether to exercise it. And I used to always get a lot of questions from that. In my last company, I was the chief financial officer. Folks would come to me all the time and ask me questions. And, I just realized there wasn't a great resource out there to explain all this. And I said, well, now that I've sold the company and, I've got some time, let me write the book.
I've started on it, noodling it. It's interesting to me since, I've kind of played not a dissimilar space and especially since I deal a lot with tech, AI development, developers and machine learning engineers, data scientists, and so on and so forth. That whole area, that whole space of talent is eaten up, permeated with startup opportunities as people try to figure out, okay, what's the next application for generative AI that's going to make a big splash, disrupt the market, make a fortune, whatever it might be. And I think there's a kind of a grungy underbelly, if I can put it that way, where it's nice if a candidate goes into an employment situation in a startup with their eyes wide open. Because to your point, if a major component of how you're being compensated is, wow, on paper, I'm a millionaire, or I've got $500,000 and I'm looking forward to exercising that, liquidating it and going off somewhere and buying a ski resort or whatever it might be. If you're a candidate, what are the pitfalls? But if you're an employer and you're a startup and keeping your talent, retaining your talent, getting that longevity of innovation and creativity and input and value from this is super critical. How would you navigate bringing a person on in that, say, a VC-backed startup or somebody's got seed funding, right. Maybe they eventually will push to a Series A. How did the two sides of that equation manage that and solve for these variables?
I think a lot of people do it by not being fully transparent, to be honest. I think in my experience, it's funny. I just gave a talk on Monday at Harvard Business School. I had 80 MBA candidates, and fortunate to be invited by the career office. And one of the questions that I was asked was, what are the tricks that employers play when they're making you offers? And so, and I think one of the, I won't say it's a trick, but I think a common practice is that when it comes to talking about equity, a lot of times the employers are less than fully transparent. Sometimes that's voluntary. Sometimes it's a bit involuntary because, and when I say involuntary, like I'm in a situation right now talking to a company about potentially joining as an advisor, and they've raised a couple of non-priced equity rounds, in the form of a safe, right? So I don't know if your listeners know what a safe is, but it's called a simplified agreement for future equity that converts when there's a priced round later. Well, that instrument does not show up on the cap table as equity. So if you're asking for a percentage of equity, whether you're an advisor, an employee, whatever, what's the number? Because you don't know what that instrument is going to convert to. And I think that's one of the challenges that both joiners, so we call, the startup employees joiners, is a term that I believe was coined by Jeffrey Busgang, a professor at HBS and also one of the general partners of Flybridge Capital. So joiners has become the sort of the general term we use, but it's a challenge for joiners as well as employers, right? Because if you can't define what you're getting, then how does the person know what its value is, right? So there's some, I guess, probabilistic assessment that you're going to make as to what that equity is going to be worth. A lot of employers, what they do is they actually offer two different kinds of packages. One where there's more cash and more certainty and less equity. And then one where there's more equity, more opportunity to participate in upside, but less cash. And I think that's actually a pretty good strategy because different employees have different risk tolerances, right? And maybe different motivations for joining a company. So, maybe you're really early in your, professional life and you can afford to take some risk. Maybe you're not, responsible for a mortgage and a couple of kids or whatever. And you say, hey, I'm taking a flyer on this. Give me the offer with more equity. Alternatively, I've seen folks who, would like to join a startup, but they've got a lot of responsibilities and they need the cash. And so dampening down that risk by creating more certainty in terms of the compensation package. And it also applies to bonuses, by the way. It's not just the equity side. I've seen people who say, listen, I may take a little bit less in, OTE, but know that it's more guaranteed, But I do think that from the employee's standpoint, understanding that startups do have a high degree of risk, that many startups don't actually succeed. I mean, and there's some, all kinds of statistics out, but, 75, 80+% of startups that are venture backed don't actually ever return the full amount of venture capital that they raise. They just never get there to an exit that's successful enough to pay back the investors. And the challenge with that is that if, because investors receive preferred shares and employees receive common shares, and by the way, that also applies to the founder, if the investors aren't getting paid out on their preferred shares, there's nothing left over to pay the employees on the common shares.
You got to consider when you're going in with eyes wide open, it's the old, he who has the gold makes the rules. And,
No doubt.
You think having the great idea, being innovative, well, that's going to rule the day. But as a matter of fact, the people making the rules are the people who are stroking the checks to fund it.
For sure.
It's scary in a way when you step back and you consider, wow, man, say 75% of these venture-backed companies fail. And to me, it's not just, is there potential for an exit, a liquidity event of some sort that they don't capitalize on? But you got to wonder how many people are just chasing that. How many companies, even investors, are chasing that idea rather than chasing a sound business model that's got some level of innovation, no doubt, not discounting that at all, but actually generates reasonable cash flow. Because that cash flow not only can fund growth, but it can be part of paying back if you will, or some of that capital, or other creative ways of moving the enterprise forward. I don't know, is it greed? Is it short-sightedness? Is it lack of experience? But it seems like people need to chase that business model as much as they chase the idea.
Honestly, I think it's the nature of innovation to some extent, right? Because when you're creating something truly innovative, I mean, take biotech as an example. I mean, I think biotech is the extreme example of this. You know, you can have $100 million go into a company that is trying to develop a therapy for a particular disease. And it may take 7, 8, 10 years for that, to play itself out in terms of the R&D and then, going through series of clinical trials and the approvals and all that. You can't, in that context, I think, you make a good point, but the challenge that I see is that with a lot of particularly technology oriented or med tech or biotech oriented companies, you can create an incremental business model that may create some profit. And I think that's especially true if you're providing professional services as an example, right? But for truly innovative companies that are coming up with kind of disruptive technology, sometimes it takes years and tens of millions of dollars of investment before A, you can build something that works, and B, the market actually figures out that it's something that they want. And if you look at most venture back, right? I mean, there's a bit of a chicken and egg issue when you talk about, product management and listening to the market, because, and there's the old thing that if you ask the market what it wanted in the early 1900s, they would say, they wanted a faster buggy drawn by horses, right? I mean, the idea that you could say to the market, hey, I'm going to do this thing, and do you want it? And they're going to say, well, I don't even know what that is, so no, I don't want it. I mean, in my last company, we had a visionary technologist who started the company, and I would argue he was 8 to 10 years ahead of the market in thinking about where cloud security was going to be. And that manifested itself in the fact that it took us about 6 or 7 years before we actually started to get real market traction, because people just did not understand what we were. Yeah. And I would say that, we had some VCs who were willing to back us with a lot of money because they saw what we saw, but it took the market a long time to catch up. So I hear what you're saying. I think that, true innovation takes a big leap of faith, sometimes a lot of investment and a long period of time. And at the same time that you're doing, what you're doing to try to solve problems that you see, there may be 20 other competitors trying to do the same thing. And out of that group, 2 or 3 are going to emerge. And that's where that's right. And that's where the failure rates are, right? Everybody's chasing the same problem, but not everybody is going to be equally successful, because some may get there first, some may have better sales and marketing, right? Some may just have, more plugged in backing or more money and can sustain themselves.
They may be able to navigate a bureaucracy like with the FDA or someone. But, when
Absolutely.
I think startups and VC and that sort of thing, I don't necessarily think grand enterprise. A lot of times companies that are failing too are just small endeavors. And it's somebody with a good idea who, people believe in, but there's not enough meat on the bone, so to speak, to attract enough investment dollars to get through that valley before you can get up the mountain on the other side. They just don't make it. I'm not going to name any names. I've got a guy, brilliant fellow in my head right now, who's been in that scenario, and he struggles and he won't let go of what he's working on. And the tech he's developed is scary, phenomenal in what it does. But the market's not there yet, like you said. But getting money and the vision to believe in it, because there are other competitors, is tough. And he's had some, but nobody with the real clout. And I think that's a recipe for failure. If you go in you don't have enough blood flowing through your body to energize it, to get you the oxygen you need to your muscles to get up and move around.
Frequently, I use the term pathological optimism to refer to founders, because in order for you, starting a company is not for the faint of heart. Building a company requires overcoming a lot of obstacles. And you have to have a level of faith and optimism that can stare down all evidence that what you're doing is going to fail to keep going. Right? And it's not usually a logical thing. Right?
Right.
But to your point, I mean, the stats that I've looked at suggest that, out of all the technology companies that are started, only about 1% to 2% ever successfully attract venture capital. And if you talk to any VC, they will tell you that they screen hundreds of companies before they decide to make an investment in one or two. A typical VC may make 3 to 5 investments a year, maybe even fewer than that, but they're going to look at hundreds of business plans and pitch decks.
Well, I mean, you have to, because we're in a time where I think there are layers of people out there who think, well, I've got a great idea because I like it, right? And they're going to go through the effort and go through the motions and go through the process. And like you said, you can be pathologically optimistic and not really understand or see with clarity how the market's going to receive it. Because most people who invest aren't looking for a return in a decade or two, unless that's their strategy, their thesis. Most are looking for, where are you going to be in a year or two?
Right.
And maybe not for exit, but I want to know that my money's earning something.
Unless you're a Japanese or Korean company, you've got a 50-year horizon. I remember looking at doing a case in business school. I think it was Mitsubishi that had a 250-year plan. But you're absolutely right. Yeah, no, they're thinking they're thinking in centuries, and we're thinking in quarters.
What do you think? What do you think as a candidate? We're in a time in a market right now where large companies are shedding a lot of employees.
Right.
Not maybe necessarily a lot in terms of their total head count if they're in the big companies, but a lot that it gets attention. They're in tech, generally speaking, and they're laying people off. And now you have this talent hitting the streets. Now, there are some sectors where they're getting gobbled up and others where they're scratching their head wondering what's next. Obviously, somebody coming out of a big company with good experience is like, well, I'd be interested if someone smaller knocked on the door.
Right.
If there's an opportunity. How should a candidate who is in their career transition, looking for their next opportunity, how should they vet a startup that they could add value to, that wants them to come on board? What should they be asking, looking for in the interview process when they do their research, and whether or not, hey, is this company going to be here 6 months or
right.
2 years from now, or whatever it might be?
When we say startup, we kind of use that term kind of generically,
and broadly.
Yeah, and broadly. And startups can be anything from 2 people in a garage to a company that's raised $100 million of venture capital and has a couple hundred employees. So in my book, right, I talk about a framework called the proof continuum, which is 7 stages from when a startup is founded at the concept stage all the way through exit. But let's say, because exit can happen at many points in that journey, but when it reaches sustainable positive cash flow, right? And those 7 stages consist of having technology. So I call it proof of technology, proof of a product that someone will buy, proof of repeatability. So, the first products are often sold to people that the founders know, or, some of your investors might know, your friends who are willing to take a leap of faith. But then you've got proof of repeatability, proof of scale. So, you've proven you can sell the product over and over. Now you've got to show that you can scale the company to serve many customers. And then you move to profitability and cash flow, right? So the first thing a candidate needs to think about is, where is that startup on its development curve, because the earlier they are toward the concept stage, the higher the degree of risk, right? If you haven't proven that the market cares about what the company is selling, that's an inordinate amount of risk. And, when you talk about 75 or 80% of venture-backed startups failing or not returning capital, that percentage tends to be higher the farther you go toward the concept stage, and lower as you get sort of farther down the curve. Because once companies have established customer base, and so a lot of startups get bought because they've sort of reached the repeatability stage with their product, right? Maybe they've got $2 or $3 million worth of ARR, and some big company comes along, or private equity firm comes along and says, all right, we see what you guys have built. We're now going to take that and start pumping it through our bigger distribution channels to our massive numbers of customers, right? So the company doesn't have to survive all the way to an IPO or to sustainable cash flow. They just have to survive long enough until somebody's willing to bring them into the fold. So as a candidate, what you're trying to assess is a few things. You're trying to assess is, where is that company on the proof continuum, right? What do they need to accomplish? Because typically what happens is, in venture-backed companies, they're getting new rounds of funding every, 18, 24, maybe 30 months, right? So they've got to keep proving that they're making progress down that development curve in order to attract capital. So the thing as a candidate, you can look at and say, all right, do they have a product out there? Do they have customers? Are they holding on to their customers? I mean, these are some of these things you can figure out by looking at the website. You can look at analyst reports. Some of it, for example, what kind of funding have they received? You can look at Crunchbase as a source, right? You go to crunchbase.com and you look up the company, and they will report on their rounds of financing. So if you see a company that hasn't raised money in 3 years and doesn't look like they're making a lot of progress, let's say there's not a lot of new features or new products that they're, announcing in the press. Maybe they're not announcing customer wins, things like that. You say, okay, well, these guys have sort of stagnated and they haven't raised money in a long time, which means they're probably running out of money or maybe running on fumes. That's a risk. If you see a company that has been successful in raising capital on a kind of a regular drumbeat because they're continuing to prove their progress in the market, that is a very interesting company. Now, I'll tell you, actually, I've been looking at a platform company that actually pulls data on about 14,000 startups and tries to project which of those companies is likely to see their employee equity value at least double in the next 3 years. And the company's called Prospect.
Okay.
The website is joinprospect.com. It's free to join right now. But it's interesting because it allows you as a candidate to kind of come up with a short list of companies that, the due diligence has almost been shortcut for you, right? That's a really interesting concept because that has not existed to date. I just learned about this company recently.
A question I have in mind too, or actually an observation followed by a question, looking at your proof continuum and how a candidate should look and measure risk versus where a company is. I feel like that's a flip side of the coin that, say, an investor would be looking as well, right? Because the earlier you get in, the more equity you can get, the lower the cost is. It's more expensive to the company, but as you as an investor, you carrying that greater risk. At each step, you have greater gains available to you from your starting point. And it seems to me that there's a need for candidates, just like investors, to have some self-awareness about what their risk tolerance is.
In the book, I talk about a concept that I call the U curve of risk, right? Which is a It's a personal assessment that you as a candidate make regarding your own risk tolerance. And I call it the U curve. And it's not a perfect model, but basically the sort of the thesis is when you're very early in your career, you don't have a whole lot to lose. So you can afford to take a flyer. And if you fall on your face or the company fails, you got a lot of time to make up for that, right? When you get, and I roughly sort of correlate that to your 20s. I mean, to me, your 20s is sort of a time of experimentation. You try some things, you try to figure out like what your career path is going to be. So let me try a few things. Let me put myself in some situations. They may have some risk. That's okay, right? It's about learning, gaining experience, and hopefully you're lucky and the lottery ticket pays off. But if it doesn't, okay, fine, you move on, right? As you get a little bit farther along in your journey, in your life journey, and you've got responsibilities, your ability to take that risk is not as great. You have to be more mindful of the fact that you may have other people depending on you. You may have other obligations. And so taking that flyer in a startup may be something that is not the wisest idea at that time. And I know plenty of people who, in their 20s were gung-ho. Hey, I'm going to take some risks. I'm going to start a company. I'm going to join a company. And then they get to be, 30, 35. And they're like, no, my decision-making is now very different. So it's not just a question of how much risk is in the company. It's a question of where are you in your journey and how much risk tolerance do you have relative to the perceived risk of what's going on in that company? And it changes. It evolves over time. I mean, it's like for me personally, I was lucky in the sense that, my first company was successful. Had that first company not been successful, so when it was successful, it gave me the flexibility to kind of keep going in the startup space. Now, my second company was not successful, right? My second company basically failed. But because I had one win already, and frankly, I had a spouse who was patient and tolerant of my crazy roller coaster ride startup journey, I had the ability to keep taking risk and to stay the course. But I had other friends who joined the second company that I co-founded, and when that company failed, they basically had to kind of retreat from startup land. And some of them have now come back a decade or more later, right? But it took them to get on the other side of that U curve where they had enough resources, and maybe some of their responsibilities had kind of lessened. So let's say their kids had already gone off to college, or maybe they're all close to paying off their mortgage. And they say, okay, I always love working in startups. I can go back and try it again now because I got enough resources, and the relative risk trade-off for me is okay to make. So not everybody's in the same position, and and that is a personal decision that you've got to make.
You and I had a LinkedIn exchange the other day, and you brought up some of the investment challenges that we're seeing in the market right now in 2024. And it struck me as interesting because it almost feels like there's a deep breath being taken, in a sense, in the market. I was wondering if you might expand for a second on what you see is happening in the VC space, in the startup space, when it comes to, hey, I got a great idea. It's innovative. It has potential to be a disruptor. Certainly there's a niche, or a focused area in the market where this can not only be impactful, but I can carve out a good spot. What are you seeing right now in terms of, I've got a great idea, but now I've got to get fuel for that, being a challenge or not for the balance of this year and going into 25?
Great point you bring up. I mean, so let's sort of contextualize this. I said in that LinkedIn post that, money makes the startup world go round, right? And the recycling of money is what makes it work. And when I say that, what I mean is VCs will invest in startups. Those startups have to achieve an exit. When they achieve an exit, the VCs get paid out on the equity, and then they distribute money to their limited partners. If they're not distributed, if the IPO markets are closed, or the other, sort of main source of exits in the venture space are private equity firms buying out, or corporate firms or private equity firms buying out these, innovative startups. A lot of that depends on using leverage, using debt. When you're in a high interest rate environment, I mean, I was talking to a friend of mine who's just left a company where, it's a technology company. Their operating cost, well, let me just say, their interest coverage on the debt that the private equity firms took out to buy their company exceeds their operating costs by 200%. So basically, the interest expense that they're paying on the debt is 3 times what their operating expenses are to run the company. And so the company is completely handcuffed, right? They've had, rampant regular layoffs. They can't invest in anything. If they hire people sort of get wind of this and they leave or they get laid off. So when you think about what's happening in the markets, with private equity being stymied doing deals because of high interest rates, and the IPO markets have been relatively closed, what that means is the big institutional investors, who are the LPs in the VC funds, are saying, well, wait a minute, we've invested all this money in venture. We're not getting any cash return on that. So we're going to stop putting money into new venture funds. And when new venture funds funding to the firms dries up, then the firms don't have money to invest in the startups. And so it's this vicious cycle that's happening. And until the top of the funnel gets uncorked, that's probably not going to change. So what does that mean for the founder of a startup today? Well, it basically means you've got to bootstrap your company. So in the past, a few years ago, a lot of times you could get some basic, seed, pre-seed funding, seed funding, maybe even a Series A funding before you had any meaningful customers or revenue. That's almost impossible right now, right? So you have to bootstrap your company to the point where you have some traction in order for someone to say, yes, I will write you a check, right? And so it's a bit chicken and egg. Like, well, how do you build revenue and a customer base? You got to build your product first. You need money to build your product. Nobody's giving you money. So what is the ultimate kind of fallout of that is that, and you see it in the statistics, underrepresented groups, minorities, women, who typically have been underrepresented in receiving venture capital, and often are the ones who have the least access to personal networks and resources, who are willing to back them in that very early stage of getting something off the ground. They're just not getting to the point where they can get venture funding. The statistics on funding from venture capital groups to underrepresented founders has dropped dramatically in the last year, because those underrepresented founders can't get their companies to the point where the VCs are demanding they be before they write a check. It's a really kind of sad dynamic, honestly, because there's a lot of work being done trying to expand access to capital for underrepresented groups, but the dynamics of the market are making it harder and harder.
There's not going to be a magic solution where somebody gets the genie bottle and uncorks it, and you rub the bottle 3 times and suddenly it's done.
Yeah, the magic solution is going to be when interest rates start to come down and the IPO markets loosen up, which, by all indication, that may start to happen second half of this year. We're in a little bit of a holding pattern until that starts to happen. But the flip side, though, is that historically the returns in venture capital. So think about it this way: in a market where everybody's holding on to their capital, and the demands on startups are greater, what that translates to is valuations coming down. And it's a kind of an interesting inflection point, because historically the returns on venture capital as an asset class have been greatest coming out of periods where valuations had declined significantly. Makes sense, right? I mean, it's the whole, buy low, sell high. If you can get positions in startups at a lower valuation, if they make it through the hard times and ultimately get to an exit, you will have bought more of the company for less money. Well, guess what? That's also potentially true for joiners. If you join a company that has had its valuation decline, right? Let's say they had to take funding on sort of more onerous terms. Well, that then translates to the options being issued at a lower price. And I will tell you that, for my wife and me, in our career, we've had 3 times when our options were repriced, and those turned out to be the best financial returns that we got as employees. So it's both a threat, it's a challenging environment, but it's also potentially an opportunity.
Well, anytime you have a difficult environment, there's always opportunistic windows to take advantage of it, to exploit it and benefit from it. But it comes with some risk.
You talked about what should an employee do to assess risk. I mean, there's both the person who's thinking about joining a startup, but there's also the person who's already in one and their company's maybe struggling, right? And you say, well, should I stay or should I go? I mean, this is a dilemma that a lot of startup employees have to face in a challenging market because, do you stick it out? There's a sort of band of brothers feeling of like, hey, I'm part of this team. I want to help the company succeed. If I leave, I don't want to leave my, my kindreds in the lurch here, but I also have to look out for myself. One of the things I talked about at this Harvard talk the other day was that, there came a point where my last company, we were down to 2 months of cash, right? I mean, we were on the verge where we were just going to run out of money and have to like shut down and pack, pack up and go home. And that if I had left the company at that time, I would have missed all of the upside of when we repriced the options, when we got the funding round done, we repriced the options, we actually finished the product that was the thing that got the acquirer interested in us that actually got the company bought. So I was like, okay, 2 months away, and you're thinking to yourself, maybe this thing's not going to survive, but if I stick it out, maybe there's upside. I don't know. These are tough decisions.
They're real tough, and like you said, it's an individual decision, and that's what makes it challenging. Because as an individual, you're never going to have perfect information about anything outside of you, and even inside of you, you may not have perfect information, and that's where I think it becomes important for one of the hardest exercises a person can undertake is being honest with yourself. Not overly critical, not overly, proud or anything like that, but just be honest with where you're at, where you want to be and what it takes to get there, because it's easy to miss. And when you miss that, I don't know that you can properly assess risk. I think it's kind of a crapshoot. Roll the dice and see what happens.
No, I was to say, one of the things that I encourage people in the book, one of the things I encourage people to do, and I think a lot of people are reluctant to do this, but you should seek out, the senior leadership in the company, the CFO, et cetera. If you have questions, you should sit down with these folks and ask them. I was amazed by how many people in companies that I've been involved with were just reluctant to, get a one-on-one with the CEO or with me. And they would all talk to each other and they would all worry, they would all wring their hands, at the cooler. But it's like, no, well, we're here. If you want to ask the question, come and ask the question, and I will say, not everybody will tell you everything. Exactly. It's like, sitting there worrying about it is far worse than going and sitting down and having a cup of coffee with the CFO and saying, listen, can you tell me what's going on? And I always tried to be as transparent as possible. There are certain times when you're like, well, if this gets out, we're in trouble. so you don't want to share everything.
2 months of cash left. Yeah. Let me ask you this question, Gus, because here you are, you're an author, you're a CEO, CFO, C-suite guy, a startup, entrepreneurial inclined person. I mean, you've been through and dealt with a lot in your life, but I always ask guests, especially as we're wrapping up, what's your passion project? Now that you've got the book out and people can go get the startup lottery on Amazon and other sources, and you're starting to get invites to talk about it and some of the risks associated with it, like at Harvard and their MBA candidates. What's next? What are you passionate about that drives where you go from here?
So as I entered what I call my fun employment phase, which is, not where I'm sitting there playing golf every day, but where I'm trying to create a portfolio for myself of, and yeah, I am playing some golf, so that's good. But, trying to create a portfolio of ways that I, continue to learn and grow, but also continue to give back. And the book is a catalyst for me to try to help educate and empower the next generation. So I'm doing a decent amount of mentoring, particularly through some impact-oriented accelerators for early stage ventures. I also am on the board of a couple of charities. One of the charities that I am on the board of, it's a nonprofit. It's called Compass Pro Bono. It is an organization that I helped co-found 22 years ago, and I helped build it to a point, left the board, and then came back to the board recently. And what Compass does is provides pro bono consulting, basically management consulting, strategic advisory work for nonprofits serving local communities. So we started it here in DC, which is, my hometown now. But it's now in Philadelphia, Chicago, and the Twin Cities, with the hope that it's going to continue to expand to other cities. So, I'm passionate about trying to help build capacity in the nonprofit community where I live, and using business skills to help the leaders in those nonprofits be more effective in attracting and utilizing their resources and delivering services to the local community. So that, between helping startup joiners, helping startup founders, and helping nonprofits, that's kind of the portfolio that I've built for myself, in this next phase.
Oh, man, it sounds like fun and a great way to give back, because NFPs, like you said, they often don't have the resources. They have somebody just like a startup with a great idea who wants to help, who's passionate about it, and giving them the keys to the vehicle that helps them exercise that passion. I think that's a noble effort. And Gus, thanks so much for joining us.
You've been listening to Drowning in the Tech Talent Pool. This podcast is sponsored by Sabretooth. Sabretooth improves the quality of hire and speeds up the time to fill specialized machine learning, data engineering, data science, and developer roles, stretching tech recruiting budgets further by bringing the precision of retained search and the speed of contingent search to the market in one complete solution. Find out more at sbr2th.com and follow me, John Light, on LinkedIn. Thanks for listening.